right, so in this video, we are going to talk about what I think is the most important and also the most neglected part of a pitch when you are speaking to an investor trying to raise capital. So if you do everything that I teach you here, if you do everything that I explained in this video, you should have investors following up with you. You should have investors trying to get you on their calendar. They should be chasing you. So let's get into it. Okay, so how to make investors feel FOMO about your deal. So first, it's important to understand what actually happens when you send your deck to an investor. In most cases, they are not going to read it through cover to cover. They're going to glance at it. We're talking 15 seconds or maybe less. They're essentially trying to figure out if this is even worth their time. The crazy part is most people spend months and months preparing their deck just to have it die before they even get to speak with the investor. And maybe you can relate to that, right? You're getting ghosted. Investors aren't responding to your email. You're not able to book meetings to even pitch. And you have to understand that this happens because, for example, investors probably get over 1,000 deals in their inbox, and maybe they end up investing in 10 of those 1,000. Because of all this deal flow that they have to review every single day, their brain has been fundamentally rewired to filter for one thing out of anything else. And it's not what you think. So that thing that they're trying to filter for and find is FOMO. Essentially, how you induce FOMO is you need to basically answer the question, why now? So this is the part that tends to break founders' brains. You walk into the room thinking you need to prove how good your product is. You've got your TAM slides, right? Your technical differentiators, your go-to-market strategy, and you stop there. So let me say that differently. Take two identical companies. They have the same team, the same tech, and the same traction. One walks in and says, here's why we are amazing. The other walks in and says, here's why the next 30 days determine who owns this market. Again, it's important to understand it's not just about capability. Ask yourself if you are presenting something that could happen or something that's about to happen with or without them. Merit shows that you can play the game, but urgency shows that the game is already in motion and they're about to miss it. Okay, so moving on to the third point, which is power inversion. So essentially, this is what traditional fundraising looks like, right? You're the founder, you have your hat in hand, and you're asking for money. What does that mean? That means you have zero leverage. So the investor sits back and they judge you. You are leaving it up to them to decide your fate, whether you get funded or not, and whether your company goes on to make millions of dollars. You need them, but they don't need you, right? You can see how this power paradigm incredibly disadvantages you. Now, watch what happens when you introduce real urgency. So how do you create this inversion? You map your raise to external events that have nothing to do with you. Let me give you some examples. A competitor just failed or got acquired. Now you're the only one in town that actually can do what you're saying you can do. Maybe their fund needs to deploy before the quarter end. Do you have a strategic buyer sniffing around? Well, this is their last chance before you're off the market. Nobody, trust me, nobody wants to be the investor who had the deal but waited too long. So the 15-second framework. So creating urgency is a system. There's 3 steps that are super simple and super effective. Step 1 is the catalyst identification. So find the external forcing function. What's happening in your market that has nothing to do with you but everything to do with timing? Again, it could be regulation. It could be a competitor move. It could be some sort of external catalyst, but there is always something at play. Step 2 is the narrative translation. So take that catalyst and link it to your raise in one sentence. So the formula is, because external event just happened, the opportunity to capture value expires in specific time frame. And then lastly, step 3 is the urgency message that goes everywhere. So it's in your email subject line. It's in the deck slide 2, first sentence of every call, last sentence of every meeting. I can't emphasize this enough that if the urgency is conveyed effectively, the investor will understand that they cannot afford to blow you off and say, oh, we'll think about it, we'll come back next week. They need to act, and you are giving them all the reasons that they need to act. Okay, so moving on to number 5, cognitive mechanics. Investors like to think that they make rational decisions, but I'll tell you that they don't. They make emotional decisions and rationalize them later. Again, this is classic sales psychology here. The strongest emotion isn't greed or a desire to make money, it's fear. So fear of missing the next Uber, fear of looking stupid in front of their partners, fear of their fund underperforming. Fear drives velocity way faster than greed ever could. I promise you that. There's a concept called loss aversion. It's a Nobel Peace Prize winning concept. And basically it means that humans feel losses twice as powerfully as equivalent gains. So when you're framing your opportunity as something that might lose rather than something they might gain, you double the psychological pressure. Add scarcity on top of that, only 2 board seats left, or the round closes Friday, and you've created what neuroscientists call cognitive load. So their brain literally cannot process all the angles, so it defaults to the simplest decision, which is act now or regret later. I had a mentor tell me this, and he basically said that FOMO is just risk management, but in reverse. And ever since then, it's really stuck with me. So moving on to point number 6 here is hierarchical control. So what most founders mess up is they create urgency, but they forget to maintain control. So you could do everything that I just said, but if you don't do this part, it's going to quickly slide way out of your control. So let me explain what I mean by that. Urgency without boundaries is just panic. So you must define 3 things for this to matter. 1 is allocation limits. We're raising 2 million, 1.5 is committed. You can have up to 500K. Another example of this could be closure dates. Term sheets by Friday, wire by the 15th, or you're out. Again, don't come off too aggressive, but it's important to have external timelines that are not just basically, oh, we'll raise until someone says yes. So let me give you a real example of what this looks like in practice. So the average approach, take a graphene refinery looking to raise development equity before they go on to raise project finance. The average approach is the founders are going to create an amazing deck that goes really in depth on the tech and the detail and why their project is de-risked and why the upside is so great. So maybe they'll say something like, we make graphene, it's amazing, here are projections. The investor reaction is going to be something like, cool, send me quarterly updates, or sounds good, check back once you have a lead investor, check back once you guys are profitable, etc. So by using the urgency approach, you could say something like, the DoD just allocated $500 million for a domestic graphene supply chain. 3 competitors are 18 months from production. After this round, the entire sector is locked up by strategics. You have 5 days to decide if you want exposure to this market. Do you see the difference? Authority in capital markets comes from a few things, but one of the most important is the ability to restrict access. Again, that's why a lot of people seeking capital view the funders as these elevated people, right? Because they have the scarce resource that everyone is seeking. So scarcity creates value. All right, so a few more points here, but the meta principle is if we zoom out and understand what's really happening here, attention is the scarcest resource in the entire ecosystem. So it's more scarce than capital, more scarce than deals, and more scarce than returns. Okay, your job is not to be the best opportunity, but instead your job is to be the most urgent opportunity. And that difference is very, very important. I cannot overstate the importance of that. Another way to think of it is your entire objective is compression. So compressing the timeline between awareness and decision. So top of funnel and bottom of funnel. Compressing the space between interest and action, compressing their option set from thousands of possibilities to this one opportunity that expires soon. Okay, so let's lock this in. Just a quick recap here. So the screening window is 15 seconds. That's the shot you typically have when you're sending your deck for review. The primary variable is time. The primary psychological lever that we're going to pull here is FOMO, scarcity, loss aversion, in that order. The mechanism is to find the catalyst, build the narrative, and control the timeline. How do you enforce that? It's with deadlines and limits, no exceptions. And the outcome is you start to become much more selective. You're able to pick from a few term sheets as opposed to just taking whoever will give you money. So you now understand something that 99% of founders never figure out, and that's investors don't fund companies, they fund companies at inflection points. And you get to determine what that inflection point is and how you present it. Hope this video was helpful. On a side note, check the description. If you're interested in potentially working with me, I'm opening up slots to take on mentees. So if you're looking for a mentor, someone to help, you're a startup founder looking to raise capital, if you could use some guidance, if you're an entrepreneur, just let me know. See you in the next video.